Well, it's been rather an interesting year, not least due to the sovereign debt worries that have been embroiling the southern part of Europe. It also didn't help that in the middle of 2010, both the US and China underwent a mid-cycle slowdown. But in the end of the day, the rather generous provision of liquidity by the central banks around the globe saved the day for global equity markets, and so for 2010 as a whole, we've had a rather good year for equities. There's another way of looking at this, which is to say that post a financial crisis, historical evidence suggests that economies tend to recover in a sluggish and uneven way, which basically means that whilst some parts of the economy or some parts of the world economy might already be recovering strongly, there are others which are still struggling. You can also take this down to the stock level at a time when there are many companies that are still suffering from excess debt, others that might be exposed to the parts of the world economy that are already booming again are thriving. So the job of the equity fund manager is to make sure that you're exposed to the latter rather than the former. And if you do that, then 2010 was actually a year where very healthy returns could be made. In spite of all the volatility that equity markets have undergone in 2010, our fund actually had a rather good year, beating the market by a handsome margin and rising in absolute terms by double digits. It turns out that diverging economic, sectoral and corporate news flow is actually quite a helpful backdrop for our investment process, which is called SmartGARP. SmartGARP has a tendency to steer us away from parts of the market that are in trouble, in particular countries, and towards parts of the market that are experiencing a boom. And so it is not a complete coincidence that the fund has had very little exposure to peripheral Europe over the last 12 months, and instead has had most of its assets in either core Europe or in emerging markets. A couple of examples here. We've had big positions in two chemical makers, one French, Rhodia, one German, Lanxess, both of which are benefiting from, on the one hand, a rather weak euro, which is the euro being weak due to the worries about the sovereign debt in southern Europe, but on the other hand benefiting from having exposure towards the rising demand for chemicals globally. As I said earlier, we have had very easy monetary policy reflecting the uneven nature of the global recovery over the last 18 months or so, and chances are that the recovery will continue to be uneven. There are still some parts of the world economy that are at least at the borderline of deflation. Think Ireland and generally the peripheral Europe. The US hasn't really convincingly resumed strong growth either, and the housing market there is still rather weak. And so chances are that central bank policy will continue to be accommodative. And that, as a backdrop, is rather helpful for real assets in general and equities in particular. Turning to the fund, the continued uneven nature of the global economic recovery should continue to be a helpful backdrop for our investment process. It continues to lead us towards the core of Europe, and we continue to have significant holdings in both France and in Germany, and very little exposure to peripheral Europe. It also continues to lead us towards emerging markets, and we have significant exposure to both China and Brazil. In China, it tends to be more domestic demand plays, such as banks. In Brazil, it tends to be more resource plays, such as Vale or Petrobras. But having said that, even in North America, there are some rather exciting investment opportunities, and we should bear in mind that almost a third of the fund is invested in North American equities, and only recently did I increase the fund's exposure towards all stocks that are based there, and we also increased our exposure to biotech companies significantly in recent months. The only caveat I would give is that the price for strong performance both this year and in future years will always be an above average level of volatility. Sadly, I have not discovered the holy grail of beating the market without incurring any volatility. But that aside, I'm rather looking forward to the prospects of hunting for profits in 2011.